Oh, this is Rick Cortez with the March 2025 update on the Westwood Broadmark Tactical Growth Strategy. And in the last 3 months, since December of last year, we have reduced our market exposure by 25%. We've gone from 67.5% to 42.5% where it stands today. The reasons for this are as follows. Number one, equity valuations are elevated. Number two, investor sentiment got increasingly speculative, particularly after the election. Number three, the Fed has indicated a more gradual approach to reducing interest rates because of inflationary pressures, and recent uncertainty over tariffs may add to those concerns. And then finally, number four, we are seeing momentum divergences. Now, since then, there have been two developments, one positive and one negative. On the positive side, investor sentiment has gotten really bearish as the market has come down in the last week. On your screen, you'll see a slide of the AAII poll, and AAII is the American Association for Individual Investors. And this shows, as you can see on the right-hand side, that bullish sentiment dropped precipitously. In fact, this pessimism has only been seen 4 or 5 times in the last 20 years. So this is a very positive development from a contrary point of view. When everybody gets bearish, you want to be bullish. I would note that this has not been confirmed by our intermediate and long-term models of sentiment, so maybe we have a bit more to go before they get into sync. But this is a step in the right direction for the bulls. Offsetting this are momentum divergences. You know, the S&P 500 hit a new all-time high just last month. And yet, if you look at the slide on your screen, you will see that of all of the S&P 500 stocks, less than half of them have been able to climb above their 10-week or 30-week moving averages. So the market is not in sync. So in summary, equity valuations are high. The Fed has become a bit less accommodative. Uncertainty over tariffs adds to those concerns, and we're seeing momentum divergences. So we believe there are risks in the market, and until those risks are reduced, we will continue to maintain a defensive posture. And let me remind you that our tactical growth strategy, number one, has 1/2 the volatility of the S&P 500 over time. And most importantly, number two, the strategy actually gained ground during the financial crisis of 2008 and the dot-com bubble of 2002. We have a negative correlation to the S&P 500 during major market declines. And finally, number three, we can act as a shock absorber in your portfolio. So this is Rick Cortez. Thank you for joining me. Please join me in April for the next update.